as we are going to focus on performance evaluation and responsibility accounting. Now, one thing that I want to start by emphasizing is most of the concepts that we talk about in terms of performance evaluation and responsibility accounting assume that we are dealing with a decentralized organizational structure. And that is a fair assumption for most medium and large sized businesses. Now, if you're working for a very small business, you may see a centralized structure. The key distinction between the centralized and decentralized structure is that in a centralized structure, you'll generally have, like one or two upper level managers that pretty much make all of the decisions for the company. So for a small business that is owned by one person, or maybe a partnership where there's just a couple of folks running the business, that might make sense. However, for larger businesses, that sort of structure just doesn't make sense. It is far more effective to delegate responsibilities between different managers, and that is what we see in a decentralized organization. Okay. So that's just kind of some background information for you to keep in mind. Now, even with this, decentralized structure, most large companies find that it's easier to manage if they divide the company into even smaller units, such as divisions, segments, or departments. As an example, Callaway Golf uses two product lines: golf balls and golf clubs. And that's how they kind of segment their business activities. Meanwhile, Kraft Heinz, they use both geographical divisions as well as product line segmentation. So in these types of organizations, unit managers make decisions, and then top management evaluates the performance of those managers based on the results of their decisions. So in responsibility accounting, unit managers are evaluated only on the activities that they can control. So the method of performance evaluation is going to vary depending on whether something is a cost center, a profit center, or an investment center. Okay, now let's talk about the key distinctions. Okay, a cost center is a responsibility center that only creates cost. There is no revenue generated. Some of the more common examples of cost centers are going to be those areas of the business that are necessary for operations but may not necessarily generate revenue. For example, human resources, accounting and finance, the legal department. Again, these departments that are often necessary to run the business and maintain regulatory compliance, but they may not necessarily directly generate revenue for the business. Now, a profit center is a responsibility center that incurs both expenses and generates revenue. So this might, an example of this might be a product line. Or something along those lines. Now, an investment center is a step up from that, okay? In an investment center, not only does that center generate revenues and incur cost, but the manager of that center has some level of autonomy in terms of decision making, okay? So maybe they are able to make to some degree, investment decisions for their segment, such as, buying additional equipment or changing production methods or something along those lines. They have some decision-making ability. So those are the three that you're going to want to keep in mind as we continue in our studies this week: the cost center, the profit center, and the investment center. Okay, so now let's look at controllable versus uncontrollable or non-controllable costs. These are actually pretty straightforward. A controllable cost is anything that individual manager has the ability to control, determine, influence. Okay, non-controllable costs are the costs that they cannot control. The example here of a non-controllable cost would be the department manager's own salary. That's probably determined by someone above them, their manager. Other common examples of non-controllable cost would be allocated cost, things that are, say, allocated from corporate overhead or something like that. So ideally, when we're evaluating a manager's performance, we want to focus on the costs that they have some ability to control or influence. Okay. A responsibility accounting system recognizes that control over cost is different for different levels of management. As in, you'll see in the partial organization chart that's shown here, and you can also find this in Exhibit 9.1 in your chapter reading. So the lines in the chart connecting the managerial levels reflect channels of authority. For example, the 3 department managers are responsible for controllable costs incurred in their departments. These department managers report to the plant manager, who has overall control of department cost. The cost of the factory are then reported to and controlled by the executive vice president of operations for that particular group, who then reports to the president, who flows up to the board of directors. So by looking at this chart, you kind of get a feel for the types of things that each person is going to have responsibility for and potential control over as well. Okay, so let's talk about direct and indirect expenses. When departments are organized as profit centers, responsibility accounting focuses on how well each department controls cost and generates revenue. Departmental income statements are then used to report profit center performance. So when a company is computing departmental income, we make some key decisions about allocating expenses. One is how to allocate indirect expenses such as rent and utilities, which benefit several departments, and then also how to allocate service department expenses. Those are going to be other departments in the organization that benefit that profit center, such as payroll, purchasing, maybe human resources, some of those other central groups. All right, so direct expenses are the cost readily traceable to a department because they're incurred for that department's sole benefit. They are not allocated across departments, okay? Indirect expenses, in contrast, are costs incurred for the joint benefit of more than one department. They can't be readily traced to a single department. For example, if 2 or more departments share a single building, the benefits of the expenses for rent, heat, light, that type of thing. Service department expenses, costs that benefit more than one department, can't be easily traced to one department. The operating departments that perform an organization's main functions, for example, manufacturing and selling, benefit from the work of the service departments. But the service departments themselves are cost centers. They do not generate any revenues, but they are still critical for the success of the other operational departments. So let's look at the steps for calculating departmental income and preparing departmental income statements. All right, so we've got 3 key steps that we use to prepare a departmental income statement. Step 1, we want to accumulate sales and direct expenses by department and also total indirect expenses. Step 2 is allocating those indirect expenses across both service and operating departments. And step 3 is then allocating service department expenses to the operating departments. Okay. Again, an investment center manager is responsible for revenues and cost and has the decision-making authority to make some investment decisions for their segment or division of the business. So here we're going to look at a quick example of how we can calculate some key indicators for multiple divisions. Okay, so in this case, we are looking at a company that has two primary operating divisions. They are investment centers. We have the LCD division, and we have the phone division. Okay, so we are to assume that the LCD division manufactures touch screens and sells them for computers and smartphones, and the phone division sells smartphones. All right, so here on the screen, we can see for each of these divisions, we can see their income for the current year as well as their average assets. So let's see what we can tell based on that. All right, first thing we can do is we can calculate the return on investment for each division. Okay, so we take the income divided by the average assets, and that's going to give us our return on investment. Now, you may think, well, why is this important? Okay, because this is clearly not something that would ever be provided, to external financial statement users, but this could be really helpful to management. Because for what it essentially tells them is for every dollar of assets that they invest, they are going to get a bigger return in the LCD division compared with the phone division. Okay, so this may tell management that, hey, if we've got some extra dollars to invest, assuming that demand is there, we should probably invest it in the LCD division because that's where we're going to get the most return on our investment. Similarly, this could indicate maybe there is room for improvement in the phone division in terms of managing expenses because they're not getting a return on assets that's nearly as high. So maybe we need to do a better job of controlling cost in that division. Okay. Now, these are just examples, but these are the types of things that management's going to be thinking about when they're looking at these indicators. All right. So now let's look at residual income because this is another way of assessing the performance of an individual segment. Here we take the current income less the target income, and it'll be up to management to decide how that target income is calculated. In this case, they have decided that they want to compute target income as a percentage of the assets that are invested in that particular division. Okay, so they want to get a income or a return of 8% on the invested assets. Okay, so we can see how this compares for each division. We take their actual income, then we compute what the target income is based on the 8% of their invested assets, and we see, well, how much better are we doing? Okay, again, it looks like the LCD division is doing substantially better. They have a residual income of $550,000 compared with the phone division here, who only has a residual income of $222,000. All right. Next, we can look at profit margin and investment turnover. Okay, and again, for these, we're just going to follow our formulas. Okay, so for return on investment, it is going to be profit margin times investment turnover, and we see the formula for profit margin is income over sales. The formula for investment turnover is sales divided by average assets. Okay, so we can make our computations as seen here, and not surprisingly, the LCD division has a higher profit margin than the phone division. They are currently sitting at an 8% profit margin compared with only a 5% profit margin for the phone. For investment turnover, we've got the LCD division at 3.75, and we have the phone division at 4. Now, here's something interesting that I will say about this. Okay, one thing that you notice about investment turnover is rather than being driven by income, it's driven by sales. Okay. Now, where this becomes especially interesting is when we see something like this. All right, because notice for all of our indicators that we've looked at so far, LCD has been doing much, much better than phone. Okay, so I bet when we got to investment turnover, I bet you were expecting LCD to be a lot higher than phone. Okay, I would have been, all right, but it's not. Okay, phone is actually a little bit higher. So let's put on our management hats and see what this may tell us. Okay, What it probably tells us is, from a sales perspective, phone is not doing terrible, considering the amount of assets that we have invested there. Their problem is bringing those sales down into net profit. Okay? So basically cost are the issue. All right? So it is possible that management could possibly really turn around some of these trends by simply focusing on the cost within the phone division. Okay? Their sales are solid. If we can better control cost, we could really boost their profit margin and also boost the return that we're getting on those invested assets. Okay, and the last thing that we're going to look at is a common approach that companies used for performance evaluation, and that is a balanced scorecard. Okay, now what you see here on the screen, this is just an example, okay, of some of the indicators that may be classified within each area. These would vary depending on the business. So each business would have to determine the indicators that are most applicable for them. But one thing that does not vary is the 4 categories on the balanced scorecard, okay? We're going to have a customer focus category. We're going to have an internal processes category. We are going to have a learning and innovation category, and we are going to have a financial category. Okay, so the categories are going to be the same across the board. What's going to vary is the indicators that management selects to support that particular area. But what this allows management to do is to establish both some quantitative and qualitative metrics that they can look at to kind of measure how they're doing in each of these areas and hopefully look for ways to improve their performance moving forward. So I hope that this short lecture has been helpful, and I hope that you feel better prepared to dive into the material this week. As always, if you encounter any questions or concerns, please always feel free to reach out to me.